Thank you for joining us for episode number 2 of the Next Level Leadership podcast, hosted by the Edmundson Group. My name is Shad Berry, and in this episode, I'm joined by my partner and our founder, Ken Edmundson, along with our co-author of Short Track CEO, Nick Setchell. Short Track is our operating system for mid-market companies. It's designed to help each organization develop 4 primary quadrants in order to grow value and mitigate risk. Nick's participation in that work has been instrumental, as well as alongside of our clients over the last 25 years, in helping businesses integrate their strategic, operational, and numeric conversation. Most of our clients have a difficult time measuring the value of their business, translating that into an interest rate or to a stock price, and knowing whether or not the strategy they're deploying is actually helping them win when it comes to building value in their business. So in this episode, we take a deep dive into Nick's experience and history as a trained CPA, with understanding the differences between the traditional approach to accounting, which is absolutely necessary, and the operational format, or what's known as the DuPont methodology for accounting, and the application of those 2 different approaches to understanding your numbers. And our effort in this conversation is to help you as the business owner and leader better understand why the numbers that you're looking at from a traditional accounting perspective are not necessarily giving you all the information you need to determine whether or not you are growing value. They're important, absolutely vital. So if you're an accountant joining us, we are not diminishing that whatsoever. However, when it comes to managing your business and connecting your strategy and operation to the numerical component, the operational format is vital to understand, and incredibly energizing when you understand it and have a better sense of whether your business is getting stronger or weaker. So I hope you enjoy this episode. Thanks for joining us. Well, thank you for joining us for another episode, our second episode of Next Level Leadership and the Next Level Leadership podcast. I'm thrilled to be here with our business partner, friend, a co-author, Nick Setchell, who has just recently taken one of the longest flights in the world from Australia, 16 hours, 25 plus hours of travel to be here with us in person. So really glad to have you with us. And obviously, my dear friend, partner, Ken Edmundson of the Edmundson Group. Thanks for joining us. He didn't have a choice, but we're glad that he's here as well. So today, because of Nick's background and expertise, if you've been around the Edmundson Group and Next Level Leadership for any period of time at all, you have heard us reference Nick's work. You have seen that. You have heard about that. You have heard us quote him, and many of you have met him and benefited from his expertise. So the purpose of our conversation today is to really take a deep dive and a look under the hood around financial literacy, how to measure, really how do we measure the businesses that we're building, and are we doing that well as business owners and business leaders. So really, I'd love, Ken, for you to kick us off. In your experience as a business owner and as a consultant and business advisor, what has been your experience interacting with business leaders and their level of, if you describe it as financial literacy or the way that they're interpreting or measuring the numbers, what's that like traditionally for them?
How much time do I have?
Unlimited.
Well, we wrote a book about it,
Yep.
So there's a lot there. And before I kind of describe the journey that I suspect all of us as business owners experience to some degree, some greater than others, I want to just mention where Nick and I have made this work come together over the last 20 years. And it's actually been almost 20 years now. And Nick hit a topic in a meeting I was in one time before I really knew his subject matter expertise was this very topic we're still talking about 20-something years later, and that is how do you measure what you're doing? Well, if you're a public company, that's a pretty easy answer. What's your stock price? What was it when you came in? What is it going out? And that's why CEOs in those companies exist in a very small vacuum for a very short period of time, because my job as a CEO is to get that stock price up, capitalize on that, and typically they move on after 3, 4, 5 years on average. But not so with us in the mid-market. And I suspect if we were better able to measure what we're doing, we would change how we approach everything. And so let me just kind of bring that to a conclusion. Nick is incredibly insightful to how to measure your performance in all areas, but it's not just the numbers tell a story. What is the story telling you, and what do you do about it when you get those numbers? So when I heard that talk, I don't remember the exact details, but I suspect it was something. I go up to Nick and I said, listen, I need this. I needed it in my own business, but I also have clients that need it. I've never heard exactly that understanding of how to measure your business this way. And of course, that evolved over the next 20 years into what has become this partnership where we measure everything. If you can't measure it, probably, as you've always heard, it's not worth doing. So when you own a business, there is a value that you're creating. You just probably, and I say this because I didn't know it, I measured bottom line, top line revenue. How, is it growing? Bottom line, or do we have cash in the bank? Certainly important, but not things that really stimulate the business. There's a real connection between how you're performing in your business and how you feel about everything. I mean, there's an energy level. We can actually define it as a number, which Nick will talk about, I'm sure, at some point in this conversation. But to bring that to kind of a conclusion, I found in getting involved in this years and years ago and then teaching it, that all of a sudden, as I tend to kind of put it on the lowest shelf, all of us as business owners, and I'm not just talking about the owner, I'm talking about people who have a direct impact on the business, people who need to know what am I doing to create value here, which is, as Nick and I always say, your jobs are to create value, minimize risk, mitigate risk. The number that you're trying to measure has a direct impact on how you feel. As I say, every one of us as business managers, as leaders, as owners, whatever title we carry, we're generally thinking about the next problem to solve, the next issue that's in front of us, and those have an emotional impact on us. The answer perhaps is, if you know you're creating value, your approach to answering those questions, your approach to addressing those issues is far different than if you're uncertain. So in getting Nick to talk about this and give us this process that we go through, you're getting answers to more than just how am I doing financially. You're getting answers to the entire, how good are you doing in your business? Are you creating value? So I'll leave it at that. It's a huge understanding for those of us who are mid-market. We weren't trained as financial people. Now some may be, but generally that's not where we come from. We generally come from. It's
not where we started, yeah.
No, and we generally start from some sales expertise or some technical expertise. As I always say, we get to this level through battlefield promotions. We buy it, we start it, we marry into it, and all of a sudden now we're asked to create value. Well, how do we measure that? So that's what everything we've talked about the last 20 years, and that's Nick's expertise.
And incidentally, that's part of the transition from management to leadership,
Absolutely.
Which is a massive subject of this podcast and of our existence. How do you make that transition? And how do we, because I love, we're talking about the emotional impact and energy. Part of our job, we feel like in our work with clients, is to help them better manage and optimize that energy. And when I'm guessing, and I'm guessing on people, and I'm guessing on measurement and finances, and I'm trying to cobble some answers and solutions together without clear representation of the data, I'm wasting tremendous amounts of energy. So I love it when we're able to bring some information and data that's objective and accurate in real time to CEOs and owners, so that that energy can be directed in the most optimal direction. So, Nick, now that we've set the stage perfectly for you, so talk about your history in this work, why it matters so much to you, and why it needs to matter to the owners and executives of these mid-market companies.
So in addressing that issue, I want to start off by saying, when business owners don't understand the numbers that they're being given, that is actually not the business owner's fault. There's this enormous assumption that when you run a business, that you instantly become an expert on this and this and this, and you instantly be able to analyse and understand and interpret the information that you're being given. And that is a fundamentally unfair assumption that the accounting profession do not understand. So just having referenced the accounting profession, I'll just talk for a short amount of time about my background. Undergraduate qualifications in economics. Still to this day believe that a working knowledge of economics is important to make good decisions. Doesn't mean you have to go out and get a degree in economics, but you have to avail yourself of key information, inflation, unemployment, industrial commodity prices, those type of things. From there I joined the accounting profession and qualified as an accountant, and that was a very fortunate step, not necessarily the most exciting step in my career, but a very fortunate step, because it gave me an opportunity to not only learn the structure of accounting, but also serving in the audit department of a large international accounting firm. Again, not considered to be a particularly exciting place to start your career, but it gave me an opportunity to look at a significant number of large businesses and hundreds of processes in those large businesses, some done very well, some done very badly. And if you open your eyes, you can learn a lot from both. What other profession can a 22, 23-year-old walk into the office of a large company CFO and start asking questions? You just don't get that opportunity in most businesses. In the accounting profession, I was fortunate enough to get that. But very, very quickly left the accounting profession because I worked out that my interest was not measuring business, but running them. And it's when I left the accounting profession and actually got into the business leadership world, the business management world, that I started to realise that the majority of the accounting profession, assuming that their clients understood what they were telling them, it was just simply unfair. The vast amount of, a significant percentage of the information produced by the accounting fraternity, either external or internal, is not understood by the people it's produced for. And therefore, it creates a significant amount of stress at the leadership table in that part of the leadership or management agenda when the financial statements are tabled and all of a sudden everybody's meant to have this magical knowledge and they feel quite stressed.
And don't want to admit they,
right.
to a large degree, I don't want to say, well, can you explain that to me?
So what's going to happen is that the meeting will very quickly descend into operational firefighting, and I'll talk a little bit about that in a second. But let's talk about some of the challenges of the traditional accounting mechanism of recording information, because the accounting system's been around for hundreds of years. Double entry bookkeeping, very clever. But can we understand one incredibly important thing? It was never designed to help you run your business.
Right.
It was never designed to help you run your business. And the documents that a traditional accounting system produce, being an income statement and a balance sheet, were not designed to help you run your business. They were designed for a very different regulation perspective.
Right. Pay your taxes.
Pay your taxes.
Keep you out of jail.
Stay out of jail.
Do the right thing.
And one of the things that accountants don't understand is this format isn't particularly useful for businesses. So how's the accounting profession responded to that? Have they changed the way they produce the information? Absolutely not. They keep producing it in the same way and just raise the volume of their voice. That's helpful. Thanks very much. Now, two documents, income statement, balance sheet. Right there from the outset. Has the accounting profession ever stopped to think, why don't we just produce one document? Rather than teasing the audience with two documents, why don't we produce one document? And furthermore, if one of the documents is easy to understand and the other document is hard, which is exactly the case, typically most people with very little training can read an income statement, but can, for your purpose particularly, because I know you're fairly new to this business thing, the key issue,
I'm learning.
The key issue on reading an income statement, just pay attention here, it's complex. Try and make sure that your revenue is higher than your expenses. That's a fundamentally important issue. Now, most people, I've got to say, understand that. You go across the balance sheet, it's double Dutch to most people. So what ends up happening? People base almost all of their assessment on their numerical health on half of the information. Instantly very dangerous. And in fact, the most important numbers that you need to be tracking do not exist in either an income statement or balance sheet. We'll come back to them in a second. So the format is not designed to help you. Two documents, a relatively confusing way of producing information. So what tends to happen in businesses where that's the data set that's being provided is that the meeting descends into operation firefighting. Somebody with a strong personality, typically the owner, is going to pick up the document they understand, the income statement. They're going to run their finger down this column here, and they're going to find something that's an emotional lightning rod. It's going to be entertainment, travel, chocolate cookies, or branding. And they're going to go, why are we spending so much money on this? This is an outrage. Now, can I tell you right now, those 4 things I just mentioned are very rarely the make or break of a successful business, but they're an emotional lightning rod. So all of a sudden, the strongest personality in the room's complaining about how much we've spent on snacks in the boardroom, which, by the way, as you well know, Shad, very important. Never underestimate the importance of snacks in the boardroom. But all of a sudden, we're having an argument about why this number's out of whack, and then the meeting descends into operational firefighting as everybody's charging out the door, trying to solve the issue that did not determine the strengths or weaknesses of the business, and little or no time was then allocated to the most important element of the management or leadership meeting, which is talking about what's changing and how we're going to shape the future. Now, one of the problems is you can't talk about how you're going to shape the future if you don't understand the past. So the very first thing that we have to do is to recognise that the traditional number set isn't particularly useful in its own format. And we've got to start to reposition that data to a point where we can then do valid calculations and determine trends. First of all, trends on where you've come from. And then if you've got an effective strategic conversation talking about what's changing, you can then plot those trends into the future with a high degree of accuracy.
Not change the data. We're reformatting the data so it's useful, so you can make decisions.
Recasting it.
Well, we're going to do a couple of things. The first thing that we're going to do is to recognise the difference between traditional accounting data and what is called operational or DuPont data. Operational or DuPont data reflects the information in a manner that's designed to understand the operational performance of the business, not the external regulation of the business. So that's an important issue that has to happen. The second fundamental flaw in traditional accounting is this completely artificial concept of year ends. This line drawn in the sand, where apparently the world comes to a halt at 1 minute to midnight on the 31st of December, and then magically starts at 1 minute past midnight on the 1st of January with a completely clean slate, so nothing happened. That's just not business reality. What anybody who's ever run a business, which is all 3 of us, know is that business is this thing that just moves through time. So we therefore then have to not only get the data in a form that reflects operational reality, but we also have to report it on a rolling basis, not an individual month or a month to date or a year to date basis. So those are some of the things that we have to change to start getting our raw data making sense. What we then have to do is recognise that the most important numerics to determine strength in business are not necessarily the ones that you've traditionally focused on, top line revenue or profit or something like that, but that there are far more powerful numbers that will tell you the health of the business. And the 2 most powerful do not exist on either an income statement or a balance sheet. They sit between the 2. Now, a traditional accountant will say, oh, no, I know they're important and I calculate those. But how well do you think that the audience, who can't read both documents, who can't interpret both documents, how well do you think they're going to get to the number that sits between the 2 if they can't interpret both? They have 0 chance. So what are the 2 numbers that are the most important numbers to determine health in business? The first is the return that you are generating. Most businesses have some level of investment that's been put into the business. There are very few businesses that you can set up with no investment. So most businesses have a level of investment in the business. And over time, that investment goes up or down, depending on how well you've managed the business. Now, why does an entrepreneur invest in a business, other than the thrill of being an entrepreneur, which we all understand is an exciting thing to do? But the numerical reason why an entrepreneur invests in a business is to get a return. It's actually exactly the same reason as you invest in anything.
Exactly.
Shares, property,
Stock market. Yeah.
Cryptocurrency, if you want to get the audience completely polarised. As soon as I use the word cryptocurrency, like the audience is just turned off because it's all rubbish. The other half's going, oh, I like the sound of this. The reason anybody invests in anything is to get a return. Now, for most entrepreneurs, the amount of money that they've invested in their business is quite likely to be more than they've put in their share portfolio or their rental property portfolio. So therefore, it makes even more sense for you to be able to calculate the interest rate that the business is returning to the owner for the investment that the owner's put in play, and then compare that interest rate with the risks that that business took. The higher the risks, the more return you get back. So when we talk about a return calculation, in simple terms, we're talking about the numerical reason for being, and you can calculate it, it's objective, it's valuable. The second most important calculation that you need to make is your cash flow. Now, you ask any business owner, do they think cash flow is important? And they're going to go, oh, yeah, of course I understand cash flow is important. Cash is king. Yeah, cash flow is important. No surprise there. But if you ask that same business owner, what is the first document that you pick up when you get your monthly finance pack? 49 times out of 50, 99 times out of 100, they'll say, pick up the income statement, which tells them nothing about cash flow. So it's all very well to say that you think cash is important, but surely we need a number set that's going to elevate that importance such that it is one of the two top measures you're looking at. If return is your numerical reason for being, cash flow is your passport for survival. So that's the start of the process, all within the realms of reflecting your data in an operationally accurate fashion and in a rolling manner. Those are your two most important numbers.
Yeah, and the part of the premise of leaders being more responsive than reactive. We talk about operational firefighting when we're kind of chasing our tail or jumping at shadows, as you put it in the past, of trying to look for these needles in a haystack, versus being able to see a clear narrative or tell the story of how the business is traveling, how it's moving forward. So I guess I'm curious why the accounting profession is not more proactively, in your opinion. I know not to get controversial, but why are they not more proactively adopting some of those practices of the operational format?
Well, I think I could probably throw that question back to the two of you, because you know more about personality profiling than perhaps anyone on this planet. How many accountants have you done assessments on that demonstrate that their fascination and passion in life is shaping the future, or indeed is the key trait that they're very good at measuring the past? So let's just unpack this a little bit. And you need look no further than the training to become an accountant. Right. Now, I'm allowed to talk about this because I'm qualified. Haven't been an accountant for over 30 years, but I hold the qualifications still, actually. 100%, there's an interesting number, of the training that accountants do is on measuring the past. So on what planet do we live on where you think that the person who is 100% trained to interpret the past has become an expert on the future? And that has not changed for 200 years. So let me extend that to start talking about the concept of budgeting versus forecasting. Traditional budgeting, which has typically been a once-a-year event, which starts 6, 7, 8 weeks before year end, typically, before this artificial line in the sand. The traditional budget process starts. It's typically driven by the finance department, which is an interesting place to drive a conversation about the future, but we'll put that one aside for a second. It generally takes a number of weeks. It eventually gets signed off by the leadership team or the board. And then within 30 to 45 days of the new year, things have changed dramatically, because as you well know, you've heard me talk a lot about being in a rapidly changing landscape. Things have changed dramatically, and in that traditional mechanism, very quickly that budget that was cut into stone at the beginning of the year is out of date. So how has the accounting profession traditionally handled that? They spend the rest of the year talking about budget actual variance analysis, variances that occurred simply because they didn't have perfect vision of the future at the beginning of the year. What a complete waste of time. So if you want to establish a more effective way of being able to not only see but also shape the future, what you have to do is to recognise that forecasting, as we call it, is an ongoing responsibility. It's a rolling responsibility. As your landscape changes, your perspective of the future changes. And we have said for some time that the businesses that forecast the best are the businesses that have the best mechanism and structure to talk about how their landscape's changing. And all three of us are very fond of the question, what information's come to light in the last 30 days that changes our view of the future? Now, when we sit groups of executives down to have that conversation could go on for 2, 3, 4 hours because so much is changing so quickly on the world that we now live in. But the key is to be able to have that conversation strategically first and to understand what's shifting, then to take the next step, which is to say, well, if that shift's occurring, how should or how could we change our operational approach, the actions that we're taking to do one of two things, create value or mitigate risk. And then once we're clear on what's changing and how we're going to change our behaviour, we can then ask the third question, which is, what is the numerical impact of the change that we're making on the future? Those three questions are interwoven. I'm not sure how you could effectively ask what the future numerical impact is if you hadn't asked the first two questions, but that's what traditional budgeting expects you to do. Once you've got a really tight link between how the landscape's changing strategically in your response, then you're able to produce an accurate forecast of the future. If you then have the culture, as indeed you should have, of challenging how that landscape change is shifting every 30 days, sometimes more often, then you continue to update your numerical forecast. So really the only difference is that the starting point's a strategic conversation, then it blends into a numerical conversation, but it's all about, all of these things are changing around us. How do I tweak my assumptions so that my prediction of the future remains accurate? And imagine for a second, if you will, what sort of advantage do you think you've got as a business owner if you can not only see but shape the future? And so often people will say things like, oh, I can't see the future, I don't have a crystal ball. Actually, this process enables you to not only see the future with accuracy, but shape it. And that gives you a massive competitive advantage.
Well, the question that and I want those who are listening to also understand, this isn't just about getting your revenue up, which is typically what they
we always
they'll come
grow volume
to us and they'll say the three things that we hear is, I want to increase the consistency of our revenue. I want better performance from my people, and quite frankly, I want less stress. Now, all of those are factors. Every manager, leader, head of a business, whatever your title is, if you're involved in the performance of this business, you're competitive by design, by nature. Some more so than others, but by design, you're competitive. When we compete in anything, what do we compete? How do we keep up with who's winning? We keep up with we have a scoreboard. Now, if I'm playing golf or if I'm catching fish or I'm doing it, I've got something to measure against everybody else. One of the things that I've come to really, really key in on is for you as an influencer in a business, I want you to be competitive, but I want you to know how you're doing in the game. This process that we're talking about allows you to measure the value you're creating. Same thing in a public company with stock price. I can measure, you're the best CEO in America. Why do you say that? Because your stock price went up more than anybody else's last year. In mid-market privately held companies, we don't have that. So we've created, the process evolved into, it shows this scoreboard. So and the other thing I love about the conversation is, if I'm in this business and you're in that business, I see those, well, your market's different, your people are different, life's different. No, it's not. you're doing the same thing I'm trying to do. You're trying to create value based on your investment.
You're investing money in a
and
business
so
to get a
how am I
return.
doing compared to you? Not how am I doing necessarily compared to my competitors, but I want to be able to say, I'm doing more with my investment than the guys on the same block with me, in the same town with me. Revenue, does, as Nick will say, it only tells me how big you are. It doesn't tell me how good you are. I want to know, how do I compete? How do I measure? If we had an award for the best mid-market leader, best mid-market executive,
Value creator, yeah.
we would base it on value creation.
And furthermore, it's not just a matter of looking at a dashboard that measures these things. It is ensuring another fundamental that makes this critical, and that dashboard is easy to understand. You should not need to be a qualified accountant to understand this information. In fact, we go to enormous lengths to make it so easy to understand that literally anyone can understand it, to the point that sometimes when people have a formal accounting qualification, they get a little bit sort of defensive about how simple this is. Oh, you're trying to simplify all this. Yes, we
Exactly.
are.
Right.
We're simplifying
Plain
it
English,
because
yeah.
if you deliver this incredibly important dashboard, scorecard, call it what you will in plain English, and people then understand it, then guess what's going to happen when people start understanding the numbers? They're going to start talking about the numbers, and when they start talking about the numbers, their literacy is going to improve. They're going to start to take actions, and those actions are going to make tomorrow stronger than yesterday.
One of the values that surprised me when I started using this process in my own business was how quickly my numbers as the CEO became their numbers. For years, they missed the forecast or they missed the numbers. Well, that was Ken's numbers and we did the best we could and off we go. When they began to understand forecasting and they began to understand the numbers the way we talk about them today, they began to own those numbers.
And you know why they began to understand them? Because because first of all, they were presented in plain English, but they start to talk about them. And that brings me to another absolutely fundamental cornerstone of this process. Numbers only serve a purpose if they generate conversations. Conversations only generate a purpose if they result in an action that makes tomorrow better than yesterday. One of the things that I'm quite commonly asked to do, which actually is a difficult thing to do, but one of the things will often happen is a CEO will get very excited about this process and they'll say, I want to introduce you to my CFO. I've told my CFO how fabulous this all is. And the first thing the CFO does is thrusts into my hand a big fat report this big, 40, 50 pages, sometimes more, depending on the business, which is their monthly finance report that they produce for the leadership team. And I look at it and I go, wow, that's really
heavy.
That's really intense. This must take you a long time. Oh, long time. So this looks really.
It's the reason I don't get it to you until the third week of the month.
Right.
It takes me 21 days to get this thing out. But let me tell you, this is gold, Jerry. Gold, Jerry. Just a little bit of a side reference there. And I say, this is gold. This is gold. Tell me, how well does your leadership team understand this document? How much of this document do they read? None of it, Nick. None of it. They read the top page. I can't believe I spent all this time putting all this effort in to give them this gold, and they don't even read it. To which I respond, what was the point? Give your managers, give your leaders numbers that they understand, they're going to talk about, they're going to convert into actions, and those actions are going to make tomorrow stronger than yesterday. And if that means you only give them 6, give them 6. Don't give them 50 pages. Because you've wasted your time, you've wasted their time. You've built your frustration that you're doing all this work and you're not getting respected. And you've reduced their respect for you because they're sitting there going, really? What's this guy thinking? I'm not going to read this 50-page report. Tell me what's actually going on.
Yeah, you convert the numbers, that they affect your people decisions, they affect how your brand impacts the market, it affects your vision, your culture. It's not just your cash flow that it affects. It affects all of those. And
affects everything.
We do touch on forecasting lightly until we get into it, and then it becomes a really big part of this process. And the first thing you hear, and we go through this whole iteration of what people resist in forecasting, This is a process that people can learn to do. And I use the analogy that if I work for a Fortune 500 company and I walk into the board meeting and the board chairman or the CEO looks at me and says, well, Ken, you're running a $500 million division for us. What does next year look like? And I look at him and I say, I have no idea. How could I know? I can't see the future. I wouldn't be in the next board meeting. Needless to say.
Thanks for coming. See you later.
Yeah, but we do it constantly in our businesses. We ask our sales leader, we ask our marketing directors, we ask our HR people, what does it look like? What are the numbers telling you? And they say, we can't see the future. Yes, you can. Better than you think. I'm not saying you can put...
Or even if you can't, that doesn't mean you shouldn't try.
And get better at it.
And the more often you try, the better you'll get. Now, there's one more thing I want to say about numbers and the time frame they relate to. And I mentioned earlier that all of the accounting to become an accountant is looking backwards, and so much of their reporting is looking backwards. But it's actually, believe it or not, a little bit worse than that. Let's say I'm sitting on the 5th of the month. Let's say it's the 5th of June 2024. And the finance section of this business that I'm involved in is really efficient, and they've got out the monthly results of the previous month, which, as Ken's just identified, is pretty rare. Normally it's more like the 15th or 20th of the month. But let's say we've got them on the 5th, which would be fantastic, wouldn't it? Those 5th of June we are, so we've got our May results in front of us. Those results that you have in front of you reflect how well you behaved 90 days ago. Now let's unpack that for a second, because it's really important. Let's look at this a slightly different way, and let's imagine that we make a change to our business today. Let's say a business is contemplating a price increase. It is likely to be 90 days before that price increase actually starts to show up in the results. First of all new quotes go out at the new price, the sales team start to reflect the new price, the sales team win orders start, the product or the service is delivered, the amount gets invoiced, money gets collected. 90 days before you will see the impact of that on your financials. Now, if you extend that logically, if an action today will not show up for 90 days, what that's telling you is that the data that you're looking at today on the 5th of June, that May data that was so prompt, actually tells you how you behaved 90 days ago. And the changes that you made 90 days ago were probably impacted by landscape changes that happened 90 days before that. At best, you are running a history lesson. This would be akin to driving a motor vehicle with your windshield blacked out and relying on half of your rear view mirror. It would be madness. Nobody in their right mind would drive a motor vehicle that way, but that's how most people are driving a business. There is just no logical reason for this at all. And yet, nobody's ever really told business owners that there's a different way of doing it. Well, let me tell you, the way that we use is different and it works.
Empowering.
Well, it goes back, Shad, to what you say. The reason we exist is to help organizations to improve those processes so they can get the results they want.
I think part of what we're passionate about and what you've articulated so clearly is we want to give the business owners permission to acknowledge that the data they're getting is not sufficient and make them aware that there is an alternative. And because I do think a lot of us spend so much time feeling extremely frustrated and thus insecure when people talk about their financial literacy. It's not just, like you said at the very beginning, it's not just our financial literacy. It's just that we're relying too heavily exclusively on the reports that are traditionally provided. Then what I see a lot of, and you guys have touched on this, is a lot of secondary effort to try to produce some data that's actionable, and that is inconsistent. So now we talk to owners that are changing that constantly, frustrating CFOs, frustrating their finance team. Give me it this way. Let me see it this way. Prepare the data this way. So we're trying to fabricate something to fill in those gaps, but we don't really know what we're looking at, and that's where we're trying to step in. And so I think when we're looking at a fundamental kind of overhaul at the way we're measuring our businesses, and you've touched on these throughout this conversation, but but maybe specifically some of the fundamental errors we're making, and what are those kind of key metrics? You've mentioned a couple of those measurements, but what are some of those other key indicators, those KPIs we really need to be focused on? And if we're not getting those numbers, then we're going to struggle. So like, what are the fundamental errors, and then what are those KPIs we need to be really honing in on?
So the fundamental mistakes are, first of all, we're too backward looking in a traditional model. Secondly, we're trying to glean conclusions off 2 documents rather than one. And thirdly, we're probably looking at the wrong KPIs. So if the traditional measures are the wrong KPIs, what are the right KPIs? One of the things that this system has done is to distill the measurement of business down to 6 KPIs. 2 of them we've already touched on, which we refer to as the primary measures. Return, which is your numerical reason for being, and cash flow, which is your passport for survival. Or if you want to be more upbeat than passport for survival, ability to fund growth, ability to make strategic investment, ability to acquire competitors, ability to distribute dividends back to owners. That's always a popular one that often gets forgotten.
Seems to be.
Business owners, I find, quite like getting the odd dividend. They've sometimes waited a decade for one, but anyway. So those are your 2 primary measures. And then sitting underneath those 2 to round out the 6 are 4 secondary measures, one of which is profitability, the quality of their revenue. That number's generally pretty well understood because most of that comes straight out of the income statement. The second is what's referred to as the leverage rating, which is not understood at all because it's not a number that exists in traditional accounting, but it is an umbrella measurement that tells you how well you've managed your balance sheet, an area that, quite frankly, most people ignore because they don't understand it. And then the last 2 are multiples that relate to typically the 2 biggest spends of a business. And those 2 biggest spends are how much money you spend on people and how much money you spend on materials. Now, some businesses don't have both. A services company, for example, is unlikely to spend a lot of money on materials. But of all the businesses that I've looked at, which now number significantly more than 1,500, either how much they spent on people or how much they spent on materials is their number 1 expense. And in many occasions, those 2 are their number 1 and 2. So therefore, doesn't it make sense to have an emotion-free, objective measure that tells you how well you're going in those 2 areas of significant spend? So the 5th and the 6th numbers are your salary multiple, which tells you the value you're getting out of your people, objective, emotion-free number that tells you the value you're getting out of your people, and the raw material multiple, which tells you the value you're getting out of your materials. Now, for any business, any size, any industry, any product, any service, any location, any market, those 6 numbers will tell you the strengths and weaknesses of the business. That's a massive breakthrough to have been able to distill the entire process down to 6 numbers. Then sitting underneath those 6 numbers, simple as that is probably even more simpler, and that's how we're going to change the business. There are actually only 8 things you can do to a business. People spend a lot of time trying to make things more complicated. There are 8 things that you can do. You can change how much you charge for your goods and services, change how many units you sell, change your control of your direct costs, change your control of your indirect costs, change how quickly you collect revenue from your customers, change how much inventory you choose to hold, change how your relationship with your suppliers works, or change the amount of fixed assets. Those are the 8 levers or actions. And what this process fundamentally does is to not only give you a really insightful, easy to understand measure of how well your business is performing, but it also tells you what's the most efficient way of improving that performance by changing a combination of these 8 things.
You know, I want to make sure somewhere in here that we don't tell them all the exciting things that come out of this and what they get from it, but we didn't create, or Nick didn't create something. He just evolved a process that already existed and makes it available. And the way that we do that is we take your numbers and we reformat it in something that's very understandable. And all of the things that we've talked about in this conversation come out of that. There's no magic to it. We're not re-engineering anything.
It's fairly magical.
It feels magical. Yeah, once you start.
But
in comparison to the people stuff, it's magical.
Okay, well, I would go back to say, I want to touch on the competitiveness of these men and women who run these businesses, not just the title, but the people who make the impact. I always say, give me the people in your organization who are going to make the greatest impact over the next 5 years. What do they know about A, B, C, and D? And one of those things is, how effective are they in being able to look at the numbers and take action? And this is what that process is designed to do. It's not turning them into accountants. It's not turning them into financial experts. It's turning them into people who can take action to improve the scoreboard. I want to grow the value of this business. That's what everybody's trying to do.
Well, and to know that the efforts you're taking are actually having a meaningful impact, that they're actually driving.
Take pressure off of yourself.
Right.
Stop trying to lift that rock barehanded.
Right.
Use some leverage in there.
And you've referenced this a couple of times now, and I think it's probably worth describing, and just for people who don't know, you've referenced the DuPont methodology or the operational approach. And I think that's just a fascinating history lesson that most of us just aren't aware of, that innovation ever took place. And that's what you're referring to, that we didn't invent this process, but we're trying to make it.
But do you want to hear a little bit about what that was and how it's been brought into the modern age? So the DuPont process is over 90 years old now. It's been around a long time. And how the DuPont process started was back in the management meetings of the DuPont organization, well known to many chemical engineers. Engineers, typically bright numerical people, but not necessarily trained in finance. So what was happening in these meetings 90 years ago is the accountants were walking into the meeting with 2 documents. Here are your 2 documents, handing them out. And the engineers, who were bright numerical people, were picking up both documents, picking up the income statement and going, okay, yep, pretty clear, I can understand that. Revenue's this, expenses are that, yep, have a bit of a chat, move on. Picking up the balance sheet and going, whoa, double Dutch. Really no idea what that's telling me. Push it to the side. One day, one of those engineers put their hand up. Brave thing to do, significant breakthrough, and said, I've got a question. And I know it's going to make me look stupid, but I've got a question. I really don't understand the second document. I'm assuming it's important because you keep giving it to me, but I don't understand it. If there's anything on this second document that I'm meant to know to do my job better, could you please explain it to me in plain English? What a great breakthrough question. So what happened is the engineers sat the accountants down and asked them to go through every element of the balance sheet and explain it in plain English. No accounting knowledge needed. What does this mean? What does this mean? What does this mean? And as they did that, the DuPont engineers started to see a different picture. See, if you ever take an objective look at a traditional accounting balance sheet, it is a raw numbers dump. They basically put all the pluses at the top, assets, minuses in the middle, liabilities, calculate the difference. Pluses, minuses, difference. It's a raw numbers dump. It's not a functional document, it's a raw numbers dump. That's why it's so hard to read. But what the engineers saw was a different picture. And they started to see not just assets, liabilities, and equity, but they started to see things that funded the business or things that operated the business. So they came up with a way of recasting the balance sheet. Everything was still on there, but recasting it to put all the funding this side, with typically the funding is a combination of the owner's own money, equity, or somebody else's money, debt. By the way, if you can come up with a third way of funding a business, I'd love to hear about it. But in my
Legally.
you might, no, even not legally. It's either your money or it's someone else's.
Right.
Whether you got it legally or not, different issue. Let's not go there. But there are only 2 ways to fund a business: your money or somebody else's money. That's kind of it. And then the other side is how we're using that funding to get an outcome. So they redefined the balance sheet into what was called a DuPont and operational balance sheet. Now, to this day, the accounting profession haven't forgiven them, because the engineer's balance sheet is significantly more valuable than the accountant's balance sheet.
Is that really a source of tension in the...
A little bit, only when I'm giving presentations. Right. And there's an engineer and an accountant sitting next to each other, and I say, now, Mr. Accountant, could you please turn to your left?
It's the Apple Microsoft conversation.
Right. Could you turn to your left and thank the engineer for making the accounting world better? And for some reason, that doesn't go down well. But anyway, I digress. So the reality is the DuPont mechanism is very clever. Pretty well every public company in the world uses it.
Okay.
But as I was working my way through this journey, or sometimes I think it was a crusade, because it's been a passion of mine for over 30 years now to try and make numbers make sense, I would ask groups of executives, and I was lucky enough to be invited to speak to many, many groups of executives around the world. I'd ask groups of executives in private companies, in mid-market companies, how many of you are familiar with the DuPont mechanism and use it to interpret your numbers and make better decisions? And in a group of 15 people, I'd almost never get a hand go up. So early on this crusade, I'd say, well, why not? This is a much better way of looking at numbers. And I'd get all sorts of answers from the brutally honest, never heard of it, which is quite fair, right through to tried it and it was too complicated. And believe me, it is. Raw, traditional DuPont analysis is very complicated and most people give up. But I encourage them not to. And I say, look, what I did was instead of giving up, I rewound the clock 90 years to the original research and started taking it apart piece by piece by piece by piece. And then once I'd taken it apart, I started putting it back together again, piece by piece by piece, in a simplified manner that was suitable for private mid-market companies. Because there are differences between mid-market and public. You've talked about that many of your podcasts. And as I put it back together again, it was easier to understand and specifically suited to mid-market companies. But most people haven't gone through that process of research and development. So while I didn't invent DuPont analysis, what I have done is created a private company equivalent.
Our platform is proprietary, no question about it. The way it's presented, the way it's calculated.
Well, the simplicity of a business of any size.
But I want them to understand there's the concrete underneath it is solid. It's just the format of how it's done is the genius of how we present this and what you learn from it and the power you get from it. So there is a platform. We've not talked a lot about that. But there is a platform. There is a process. Yeah. We encourage we have to have it.
Well, it's an integrated part of our operating system that we've talked about. So the Short Track CEO operating system.
I want to know how you're doing. I want to know how you're feeling. The best way to do that is to look at this value creation that you're coming to.
It's a great way to get a very clear visual representation on the overall health and well-being of the business and you didn't dive into this as much, but what we love to do is integrate that strategic operational conversation. And is that generating that numerical outcome? Is it moving us every 90 days, looking that in a rhythm, looking that in a cycle, getting more? And I really feel like we're desiring to equip these business owners to be more scientific in the way that they're much more higher resolution, where we're doing less guessing, less whack-a-mole, where we're seeing, and it's so inspiring to your leadership when you're able to see tangible, and y'all talked about the cohesiveness with your entire management and executive team when you are sharing the experience of saying, hey, remember when we had that conversation and we made these actions? Look at the fruit that's producing. Seeing that as a trend. So
we haven't gotten into it, shouldn't probably today, but it's another podcast, but getting into the J curves, more into the forecasting, all of those things live in this process and are so integral to growing the value. And I would say this, it's out on the edge, but I've seen it where your team becomes more cohesive. They feel they're building something. They're looking at the scoreboard. They benefit from the rising value.
Well, they're all involved in the improvement,
right?
And that's incredibly motivational.
It's not what are we focused on this month? What happened last month? What have we got to catch up last month? And we didn't talk about the rolling 12s and trends.
Well, that's what I think I want to. I think what I'd love, and we can kind of wind down with this, but I think it's so relevant to this broader conversation of understanding. This may be more widely understood, but the rolling 12. And looking
I don't think it's widely understood at all.
Maybe not. Yeah. So maybe as another kind of, because that's a massive principle in terms of how we look at these measurements. So describe some of that and what benefit there is to adjusting as opposed to the traditional 12-month fiscal year.
So we touched earlier on about the concept of this artificial line,
Right.
being year end and resetting the clock to zero at the beginning of the new month. For external reporting processes, the law says you've got to do that, and that won't change. Nothing we do will change that.
And we're not advocating.
Right.
No. But one thing I've always said is that this use of numbers that we're referring to is your internal management use of numbers to improve your business. It's not your external statutory or regulation reporting. So the reality is that within your business, there's no rule that says at year end, whatever that artificial date happens to be, you've got to reset the clock to zero. If you've got a number set of 12 months, let's say you're adopting this for the first time and your year ends December, as it often is here in the United States. Come the end of the year, the law says that you've got to calculate your results for 12 months. Now, a month later, you've got your January results. There's no rule that says you have to reset the clock to zero at the end of December. You could take your 12 months to December, add on January of the next year, and drop off January of the previous year. And what you've done is you've gone from 12 months January to December, the traditional order of months, to 12 months from February to January. Both of those data sets, or plot points as they'll appear on a graph, have all 12 months of data. And the immediate benefit that brings to the conversation and the trend analysis, critically important that we understand this is always about trend, not about an absolute or a single number. But the immediate benefit that brings to the trend analysis is it removes the impact of intra-year seasonality. Because each time you're looking at a data set, you're looking at 12 months. So for businesses that have got a quiet period of the year or a busy period of the time, or spring break,
holidays, whatever.
Or Mary's trying to explain why last October we had this event and we're going to have it this. No, you've got an October in every number. You've got a spring in every number. You've got a summer in every number.
So what it does is it removes the impact of intra-year seasonality, which is often a smokescreen to understanding, and it basically then tells you whether you're getting stronger or weaker. And once you know whether your trend's getting stronger or weaker, then you know whether you're heading in the right direction. Once you've got the right process that extends that mindset of a rolling mindset into the future, then you're genuinely forecasting. And once you involve all of your management team in the conversations, you're forecasting better. And one of the other weaknesses, of course, of the traditional budgeting section is it's normally the finance section who's charged with the responsibility of building the budget. Now, for most businesses, if you ask the owner of the business, who is best qualified to predict and influence the future, who is least qualified to predict and influence the future, you'd probably be told the sales team followed by the operation team are best qualified to predict and influence the future, and the bookkeepers the least qualified. And if that's indeed true, which often it is, why would you then go and ask the bookkeeper to produce your budget for next year? The least qualified person? Makes no sense. So what this is about is getting all members of the management team engaged in a conversation they understand, in a conversation they want to have, in a conversation they should have, and making sure that we're using numbers to create actions to improve the performance. And as we check in on that process, that's a strategic process, an operational process, and a numerical process, and as the business moves forward, that's incredibly motivating. For the management team, for the owner, for everybody. And those businesses beat their competitors.
It's consistent. The rolling 12 and that model is consistent too with part of our philosophy with that, which I think Simon Sinek has popularized well, of the infinite game. You know, we use sports analogies as if there's a start and a stop and a scoreboard and somebody wins or loses at the end. But with business, it is ongoing. The goal is to stay alive and in the game as long as possible. And so that's really, and it's
more Monopoly.
Yeah, that's right. It's far more motivating when you can see those trends, even if there's a dip, if you can catch that more quickly. Because I think the other thing that happens on the dark side of not using that rolling 12 is you don't catch up with some of those trends until it's maybe too late. So you're able to be far more responsive and sensitive to some of those changes in the way the business is going, and then take meaningful action, responsible action, and be unified as a team to see, hey, this happened, this is objectively happening. This isn't something I'm just afraid of because I woke up last night and thought about it. Like, we're seeing this change. What's that about? So incredibly empowering, really personally grateful for the work, not only as an advisor, but also as a business owner, to be able to understand and really have stronger comprehension of some of these metrics, because most of us are running and leading things we care deeply about. You're wanting to see your kids grow in health in all the appropriate ways. You want to see your businesses growing in health in all the appropriate ways. True. And so this is bringing a lot of clarity to focus the spotlight on that. So I really appreciate the crusade you've been on. It really is. Like, when you're, we all know when you're around passionate people, when the things they care deeply about, like, we could go if I asked you a few more questions, we'd go another hour and a half on this conversation, because you've spent so much time in depth, and I've benefited from that. I know our clients have benefited from that. So
absolutely. Yeah. Absolutely.
So thank you for the work.
So the question that I'm sure those watching this are going to probably wonder why we haven't addressed. Around the table, we have operational people, we have people with great numerical minds. I have on blue shoes. You have on white shoes.
That's right.
He has on brown shoes.
Leather.
What does that tell you about our personalities?
I think it's just a cultural, from down under,
is it
distinction.
It tells you that one of the three of us has made an effort to put on some business attire.
All right.
That's what it tells you.
Well, then we're going to cut this from that. But I did notice as I was sitting here, there's quite a diversity here among us. But
yep, that's right.
When we come together, we make a pretty good team.
Well, it's evidence that you can have a diversity in fashion, sense, and style, but be united around how to measure a business accurately.
All right.
If I had red shoes on, it would have been red, white, blue. Where else is that work effectively?
Absolutely. Absolutely.
Thanks, Nick. Appreciate you.
Pleasure.
Yeah.
Good job.